Welcome to the Think Generational Wealth Podcast, episode number 82, and I am your host, Amir Estimo. In today's episode I wanted to dive in a little bit deep. I know I've talked about this in past episodes when it comes to life insurance, but I kind of wanted to give just probably like the basic understanding of life insurance and why is it important to have it. I know in past episodes I've talked about it because life insurance is something we don't think about much because it kind of brings out the inevitable of one day we're all going to pass away on this earth. It's bound to happen. It's just a matter of when. And the reason I want to talk about this a little bit more is, first of all, I'd like to open up and say I am not a financial advisor. And so if you need financial advice, this is not a financial advice. This is just based off my opinions and my research personally. Okay. Second of all, I would like to open up. I usually always do this almost is I would like to open up with appreciation and gratitude. I appreciate and I am grateful for anyone that takes the time to listen to this podcast. Hopefully this podcast is of great value to you because you could be doing anything in this world. But the fact that you're listening to this is much appreciative. Also, leave a rating and review. Leave a 5-star review if you enjoy the content. Like and share it. Rate and review. I would like to know what's on people's mind. What would you like me to talk about more? What would you like me to cover more? What would you like me to stop covering? It's only going to make me better, folks. And it also helps the algorithms and get the show more exposure. Okay, so let's talk about life insurance. So you have life insurance. So when you're in your probably, I would say 15, 16, when you're young, people don't realize your parents could have gotten life insurance for you, even at a young age. They have life insurance for kids, and that's something that we don't know. But as you get older and you're young, you get 23, 24, 25, when you're around that age, you probably think that, you know what, I'm going to be living forever. But that's not really what happens. Then when you get into your 30s, you settle down, maybe get married, have kids, have a family. It even becomes more important and magnify why you should have life insurance. Same thing about 40, because now you start to realize the cost of life insurance goes up. Your 50s and 60s, you can still get life insurance, but it's really expensive because they're basing off the fact of mortality, health, etc. So the perfect time really to get life insurance is anywhere between your late 20s and 30s. You want to have that protection in case something happens to you in the event of your untimely death or whatever that is. Then you have your family taken care of. This is not, I know a lot of people look at this and say, well, I don't want to do this and I don't want to do this. I'm not leaving my wife for this. But it's not about, especially if you have kids and if they plan on going to college and all that. We all know college is expensive. This is about them, not you. That's how you have to think about when it comes to life insurance. Again, because we're all going to pass away. So why put your family in a position to where if something happens to you, it's a struggle for them to continue to live. That will be irresponsible on you. So now we have different types of life insurance. Now there's a whole bunch. There's different types of life insurance, but I'm going to cover 3 types of life insurance. You have your term and you have 2 permanent life insurance, which is called whole life and then index universal life insurance. Let's start with term. And I'm going to talk about the advantages and the disadvantages of each one. Okay. Now with term insurance is what it is. So let's say, you have a kid at the age of, let's just say 30. Okay. And you want to make sure you're covered, like you don't have the net worth yet. Because when you're in your late 20s and maybe early 20s, you're still trying to build up your financial portfolio. So at 30, you still don't have it all together yet. Now, if you do, more power to you. And that's actually, you're already ahead of the curve. But for some of us who who started our financial journey a little bit later, this is a great way to start building, to at least have that protection. Now, if you have, the net worth, like $1 million of net worth and so on, may not be the best thing for you. But if you don't, this is. So then let's say at 30, you get like a 20-year term. So that puts you at 50. You're around at least all the way up until your child or your kids are old enough to go off on their own on the world. So term insurance, you get a 20-year term. And sometimes 20-year term, depending on how much the coverage is, could range anywhere. I don't know exactly, but it can range anywhere from, I say, $200 to maybe even $1 million, just depending on what you're rated, depending on your health, depending on, there's other factors to this that I don't want to get too in depth into high level. Remember, I'm just keeping this basic simple so we can understand. This is not anything to be high level. If you want more high level stuff, you could always just do that research on your own, or I can talk about this in later episodes. But as of right now, this is just for someone who don't really understand the basics of life insurance and the advantages and the disadvantages. So now you have your life insurance that carries you over a 20-year term. Now, here's where people get kind of lost when it comes to life insurance. They look at it as, wow, let's say I'm paying $70 a month, and you never at one point use the life insurance. You're alive. Let's say you're alive until 50. You feel like it's like throwing money away. When in actuality, it's not. Think about it as here in the States, we have to have home insurance. We have to have auto insurance. Knock on wood, but I haven't gotten an accident in probably, I would say, maybe close to 10 years that I've gotten in a wreck. And I've still been paying my car insurance, auto insurance. So do I, in a sense, feel like that's throwing money away? Depending how you look at it. Because you're paying for the protection and the ease of mind. So with term insurance, you have a certain amount of time you're paying for that life insurance. Then once that time is done, then you can still get life insurance, but because now you're older, it's going to cost you a little bit more money. Now, one thing I will say, life insurance is not an investment. It is a protection. Once again, it is not an investment, folks. This is a protection. Okay? That's what life insurance is. This just gives you another avenue to where you can put your money to protect your money. But this is not like the stock market or crypto or any investment, because it's not an investment. So let's make sure we clear that misunderstanding if there's any. So now you get term insurance and you pay your insurance. But at least if something happens to you, your family is covered. Now the thing about term insurance too, it could be a little hard to get, because some term insurances you have to go through what they call medical, and then that's how they give you what they call a rating. And if you're a smoker, it could be quite expensive because they have to cover you, because smokers generally are not as healthy, and their life, they don't live as long. So that's what statistics may show. So that's why you have term insurance. It's a great thing to have if you're alive, if you don't have the net worth, you're building it gives you time to build your financial portfolio. But what happens is as you get older, it gets more expensive. So that's the thing about term insurance you want to keep in mind if you decide to go that route. There's no, there's no, let's say, you put your money into a policy and, you're going to see maybe some gains or anything like that. There's nothing like that in term insurance. It's you pay for what you get. So if you pay for $100,000 or let's say a $500,000 coverage, that's what you're getting. Period. End of story. So, and what you want to understand too when it comes to life insurance. Most life insurance, they have what they call a 2-year contestable period. In this period, this is basically like the life insurance is, making sure, like, let's say if someone decides to go and, kill themselves or something, they don't pay out. They can have the right not to pay that policy out. Okay. So that's what you want to keep in mind. After 2 years is basically fair game, So now you have whole life insurance. Now, whole life insurance is a permanent insurance. So what the permanent insurance means, it's for the life of the insured. Also with whole life insurance, you can actually, now here's a two terminology. You have the cash value and you have your death benefit. Now you can get a whole life insurance and actually, if you want to, put some money into that whole life insurance and that hedges inflation. So like right now, the markets are high, gas prices are high, inflation is just out of control right now, right? So instead of you putting your money into a stock market or some type of crypto where your money you can actually lose your money, you can put your money into a whole life insurance and that will protect protect the losses. Okay. Now you have the advantages of whole life insurance. It provides lifelong protection. It accumulates cash value. Now, cash value, there's a difference between the two. There's death benefit and then there's your cash value. Your cash value is what money you actually put in. It's like a savings vehicle. This is another savings vehicle, tax deferred, right? So you put your money into that cash value. I don't know if you guys ever heard the story of O.J. Simpson. O.J. Simpson, we know, back in the days, he was charged with criminally. He was charged with murder of his ex-wife and her boyfriend at the time. Well, he won the criminal case, but he lost the civil case. So the families of his ex-wife and then the boyfriend was able to sue O.J. Simpson, and they were able to sue for him for his personal assets. So if he has stuff like, let's say he has stuff like cash in the bank, stocks, all that stuff, they can sue him for his personal assets, in which they did. But you remember when O.J. Simpson then went to jail because of him robbing his own, stuff, he went and did 10 years. When he came out, he still had money. Why? Because O.J. Simpson took his money and put it into a whole life insurance. The government cannot go after you. They cannot tax you on your life insurance. They cannot go after you in your life insurance. And let's say if you ever got sued, they cannot take your life insurance. So that's why when O.J. Simpson came out, you guys can look this up. He came out, he still had money. O.J. Simpson was still wealthy because he had his money in a savings vehicle, tax deferred life insurance plan, like a whole life. Now, again, it provides lifelong protection. It accumulates cash value, which is what we're talking about, putting money into that. And it has a minimum rate of return. It offers financial safety net for you and your beneficiaries. So this is the whole lifetime. It has predictable premiums, which means that with whole life, the premiums, they stay the same and you know what you're getting every single month. So there's no like, hey, you're going to get 10% and 5%. If you know you're getting 5%, that's what you're getting. It does have the potential to earn dividends. And this also can help with estate planning. So you can actually take your whole life insurance and put it into your estate planning. I highly recommend getting estate planning because that's where if something happened to you, you have all this. And with the estate planning also, that's your estate. And if you think about like Kobe Bryant, his wife when Body Armor sold the company to Coke, if I remember correctly, Kobe's estate got wealthier. His estate did. So that's why it's important to have an estate. So if you have that, you can actually pass that estate to generations and generations, right? Okay. So that's where, and when I say this helps your estate plan, because it can help build your large portfolio. You can set up a trust, and the IRS doesn't consider death benefits as taxable income. So the money's not taxed. So if you have special needs, let's say your kids have special needs and all that, they can actually go into there, take money, and not pay any taxes. Now, here's the disadvantages of whole life insurance. It's expensive because you have costs of insurance, fees. It's not as flexible as other permanent policies. It takes a long time to build up cash value, because basically think of it as like when you buy a home or even any loan. What happens? They front load all the interest in the beginning. So you're not paying as much. So like, let's say you have you have the, like in your home insurance, you want to pay against the mortgage. The first few is you're actually paying interest. So you're paying interest. So if you make $2,000 payment, 15 of that, 1,500, it may be interest. And the other 500, which is what goes to the actual mortgage, is subject to interest. So if you decide to borrow against this, in which you can, because you can borrow against the whole life policy. Like, let's say if you wanted to start up a business, depending how much cash value you have in there, you want to start a business, you want to go, maybe pay off debt, or you want to, I don't know. There's things, you decide, you become your own bank in this scenario, right? You can actually borrow against the whole life. But what you have to remember is, if you borrow against that policy, and let's say something happens to you and you pass away, this actually reduces your death benefit. And here's the thing about whole life insurance too, you want to keep in mind, is that whole life insurance, let's say you have a death benefit of $500,000 and you have a cash value of $100,000. So if something happens in that scenario where you pass away, you do not get it's whatever is the greatest of the two. So if you have a $500,000 death benefit, you'll get that, but you will not get the cash value. That's what you have to understand there. If you have a $600,000 cash value and your death benefit is $500,000, you will get the $600,000 cash value, but not the $500,000 death benefit. That's why whole life, you have to understand how to construct this, because you have to have the right financial advisor advise you and instruct you how to properly set this up, so you don't have the perception that this is an investment. This is not an investment choice. And because it kind of mimics the market, like the S&P. So you may have it perform at a certain level, but if the market is down, since it's mimicking, it's not actually in the market, it mimics the market. Your money, you don't lose money, but you don't gain money either, because you have the floor, and then you have your cap, and then you have the floor. Your cap is what that whole life policy can make. Okay. Now let's get into Index Universal Life. Index Universal Life is similar to whole life, but the difference between the two is the Index Universal Life actually. So let's say, like in that scenario I was talking about, if you have a $500,000 death benefit and then you have a $100,000 cash value, if in that time you pass away, you actually get both. So you would get $600,000 minus any outstanding loans. So if you have any outstanding, let's say you took the loan out to go start a business or whatever, you would have to take that money, would reduce your debt. It would reduce what you would get, what your family would get. Okay, so like if you had $100,000 loan out, then instead of you getting 600,000, you would get 500,000. So the difference between whole life and index universal life is that index universal life, you get both the death benefit and the cash value. In whole life, you either get either or. You can't get both. Now, as far as everything else, it's kind of similar. It mimics the market. You have your floor, you have your cap. Now, your cap, when you say, Amir, what's that? What's the cap? Okay, so your cap is, let's say the market does well, it does 23% for the year, right? But if that policy has the cap is 15%, you cannot make more than 15%. So what happens is you actually lose that 8%. And you say, man, that sucks. So why would I want to do this? Okay, here's why. So now let's say the market does bad like it's been within the past year or so. You have the cap, you have your floor, which is, it could be like 0.1 or 0. So if the market does a swing, it goes to the bottom, it swings to the bottom. And let's say that market lost 23%. You actually don't lose no money. That's why this is a tax savings vehicle, because it's tax deferred. And it actually, if the market swings down instead of upward, you don't lose any money because the floor is 0%. So if the market performs terrible, you actually didn't lose any money. That's why people do these. And again, it's not, everything else after that is not, it's pretty similar to kind of the whole life. It's just another form of whole life, but it's called index universal. And you get tax advantages. You get the tax advantages, tax deferred. You get the death benefit, that's tax free. So remember, you always got, and if you have loans against the policy, those are tax free. Again, the downside of the index universal life, it's limited gains because of cost of insurance and fees. It can get quite expensive in the beginning, and if you don't fund it correctly, then you don't see you actually don't see it, because of the fact that you may not, like, if you don't max that policy out, then you may not understand and may not see the reason why to do this thing. And then with the index universal, some financial advisors do what they call like a calculation, and they try to calculate, if you put this much money, how much money you should get. But does it happen? No, it does not necessarily happen. So that's what you want to keep in mind in this scenario. So with the market doing bad right now, you may not see that gain, because if the market's performing, remember, this mimics the market. This doesn't actually invest into the market, right? So if the market is performing very well, you don't get that, unless if it gets past that cap, which is 15%, then you don't get those extra percentages. But if the market performs terrible, you don't lose money also. And then the fees you have to be aware when it comes to these life insurance, like the permanent life insurance, is premium expensive charge, which is deducted from a premium, which is, what is applied to the cash value. You have administrative expenses, which is, who's watching over, who's like maybe the insurance, the administrative, usually this is deducted from the cash value. This is basically how to manage it. The cost of insurance, you got to keep in mind, fees and commission. So, whoever has set up the policy or who's managing the account, they got to get paid. Then you have your surrender charge. So let's say if for whatever reason you may have put $500,000 and you decide this is just, not 500, but let's say 5,000, and you say, this is not for me, so forget it. So you have what they call a surrender charge. And sometimes that can cost you a lot of money. So all that money you may have built up, let's say you put $5,000 into your account, then you may end up, because of a surrender charge, it may cost you $3,000 to cancel this loan. And then you only end up with $2,000 of the cash value. So it's one of those things that if it's not something you're really knowledgeable about, don't do it. That's the best advice I can give you. But if you would like to save some money, because you think about it, let's say a 401k, right? You go into your 401k, you work for an employer, they have a 401k, and you go in there and you want to take money out. Not only you got to pay, because you're paying an early withdrawal penalty. Then also, you pay the early withdrawal penalty. Then you got to pay taxes on the money. And if you don't pay taxes while you take the money out, you're going to pay taxes later. You can do that. It gets expensive. So if you need $10,000, after all of that, you may only end up with like $8,000. Keep that in mind. Okay. Whereas in a permanent life insurance, like a whole life and IUL, you can go and take money as you please, because it's your money and it's protecting you. Like if, let's say, for example, you went bankrupt, they can't go after your life insurance. They can go after your personal assets. That's why people do these things, is because you're trying to protect yourself. You're protecting what you have. Now there's rules and regulations. Again, that's more high level stuff, and I'm not getting into that. But for the basics of life insurance, you have the understanding of two. You have your term and then you have your permanent life insurance. Okay. I hope this was of value to you. And actually, you can actually go online. You can take a look at some of the life insurances out there. Companies like Transamerica, I forgot the other one, Pacific Life. I can't remember the other one. It begins with an N. I can't remember that one. But they actually, they're really big. I know Transamerica is really big. They're really good with term insurance. I can't remember the other one. But right now I'm having a blank. But the other insurance is Nationwide. Sorry, Nationwide. That's what it was. It came to me because of Peyton Manning in the commercials. Nationwide insurance is probably better. Transamerica, I've worked with, they're really good when it comes to term insurance. I mean, it's difficult to get through it because you have to do medicals and all that. And even now these days, you don't do medicals like you used to. But term insurance, and it's important to have insurance, period. That's what this comes down to. At the end of the day, we have to think of our priorities, right? And some would say, well, why, you protect your home, you protect your cars, but you won't protect yourself and your family. That doesn't make any sense. Okay. So hopefully this is of value to you. Thank you very much. Much appreciative. And I would like to leave you with quote of the day. And quote of the day is, never be limited by other people's limited imaginations. Appreciate you. Talk to you next week.